And welcome to the Wealth Builders webinar. We are so glad that you were able to join us tonight. And I'll tell you, we are going to really learn some great things. We've got Bill Bronchick as our guest tonight. Welcome, Bill.
Thank you, Karen. It's a pleasure to be here.
Bill always has such great information for us, and we just want to welcome all of you, wish you a Merry Christmas, and just on behalf of Billy and Becky Epperhart, thank you for being part of Wealth Builders. And we're actually doing a series of free webinars that is bringing us up to the Wealth Builders Conference. We are very happy that we're going to be in person at the 2022 Wealth Builders Conference that is right here in Denver, Colorado. We're back at the Marriott. And so I know many of you are planning to attend. And those of you that haven't registered yet, we've got a coupon for you. It's WB sale. So you can register and get $60 off. And Bill is one of our speakers. I also want to welcome, we've got two more of our speakers and coaches that are on tonight. And so I just want to say hi to and welcome Frank Pulley and Mike Davis.
Glad to be here, Karen.
And with every webinar, we want to get questions from you as well. So Bill's going to talk for about 45 minutes, and then we'll have about 15 minutes for questions and answers. And the way that you submit your questions is to go ahead and put them in the chat section right there on the Zoom link. Or if you're watching tonight on Facebook, you can enter the question in the comment area, and we'll get to as many as possible. So Bill, I am really looking forward to hearing this. 5 things that we must do in 2022. That actually rhymes.
It does.
Well, thank you so much. We'll turn it over to you to get started.
Thank you. And welcome everyone to the webinar. My name is Bill Bronchick, and I've been teaching with Wealth Builders for many years now. Really looking forward to the 2022 Wealth Builders Convention because, as you know, COVID has killed all the fun. So I'm looking forward to seeing many of you that I've met before and new people I haven't met as well there. I will be speaking at the event on real estate, a couple of sessions. So if you want to learn about real estate investing more, got to come to the convention, take advantage of the code that Karen gave you. One of the things that I think that is important to know is what's going on in the world, what's going on in the market, what's going on in the economy to prepare for real estate investing in 2022 because of so many, variables that are there. I wanted to talk about today. Wealth Builders has asked me to reveal to you the 5 key things to be prepared for in 2022 when you're going to be engaging in real estate investing. So let's jump right into it. If you got a pen and paper, take some notes and then ask some questions as we go, and I'll be happy to answer them as we go in at the end. So there's 5 key ingredients I think we have to look at that are going to affect us as investors in 2022. And key number 1 is going to be higher interest rates. The Fed just announced today that interest rates are going to go up. And we all knew that in a way, which was surprising to me that the stock market went up and the stock market was just wondering, how bad it was going to be. They knew it was coming. But when the Fed announced that, yes, we're going to creep interest rates up in 2022, they didn't reveal how much or how many times. Of course, they never say that. But the stock market started going up again because of certainty. People like certainty in the markets and in the economy, and so do we as real estate investors. So I have a little cute little icon in the corner here. It looks like, how are these things going to affect us? And quite frankly, I'm just going to lay them out and give you my reading of the tea leaves. But anything goes when it comes to our economy and the variables that will affect us. So higher Fed rates is likely going to lead to higher mortgages. Fed rates do not tie directly to long-term rates for mortgages. They're short-term rates. However, generally speaking, when short-term rates go up with the Fed, mortgage rates tend to tick up too, but not always. So we're going to see how the mortgage companies react to that over the next few weeks. When you start seeing rates advertised on television or online, you may see things go up just a hair. Now, interest rates are so darn low right now. You're looking at close to somewhere between 2.5% and 3% on a 30-year mortgage. I've heard about people getting less than that. On 15-year notes, less than 2%. So that's unreasonably unrealistic to expect that to stay that way. And historically, interest rates have averaged between 6 and 8% over the long 50-year term they've been measuring it. So 2%, 3% is extraordinarily low and rare. We do just fine in real estate when interest rates were 4 and 5. When I got started in real estate investing in 1990, interest rates for investors were 9 3/4. And those of you who've been around the block a few times, maybe several times, remember when interest rates were 17, 18, 20, 21, 24 in commercial back in the late 70s, early 80s. And people still made money. You just got to know what the variables are and how do you adjust and how do you make it work for you. That's what I always ask. Whenever there's an opportunity in the market, and some people call it a challenge, but I call it an opportunity, I always ask, well, how can I make this work for me? And that's what you have to be asking yourself. When you see something happen, whether it be interest rates rising in the economy or jobs or COVID or any of these factors coming up in these variables, ask yourself, how can I make this work for me? And when you ask that question, you get very good answers. When you ask questions like, well, what do I do now that's going to go on? That's a negative thing. Ask it in a positive way. And it's amazingly, you get great answers, great answers. So higher interest rates in mortgages, if they go up substantially, means less buying power for buyers. So if interest rates go from 3 to 6, that means a buyer can afford half the payment. And that means theoretically prices would drop 50%. That's not exactly how it translates though, but certainly if buyers have less buying power, they can't afford as much payment. They're not going to go for a more expensive house. And obviously the higher end of the market starts to suffer first. Now the lower end of the market, what we call the starter or entry level, not really bad stuff, but what we call sort of working class neighborhoods, the 3-bedroom, 2 baths, 12 to 1,500 square foot house that was built in the 50s and 60s. That kind of stuff is just in short supply. They're never going to build that stuff again because builders can't afford to build that small and make a profit. That's why when you see new houses on the market, I'm shopping now with my wife to buy a new house, and there's just not a lot available. So we went looking at builders, and builders are starting houses at 6 and 7 and 8,000 square feet standard, which is just too much house for 2 people. And the challenge is if you want a nice house, you have to go with a bigger house. And I don't want a 7 or 8,000 square foot house. It's just wasted space. So if you have a product that is in short supply, you will always do well regardless of what the economy does. So those lower end properties, if you have them, keep them. If you don't, buy more of them. And it may translate, if interest rates go high enough, to lower prices or a flattening of the market, where prices won't drop, but they won't go up either. Most likely scenario I see is still an increasing market in most areas. However, it's just increasing at a slower rate. We're not going to see the craziness that we've seen in the last 2 years where people are, overbidding multiple times on properties that are listed within 3 days. And, that craziness is going to soften up quite a bit. I still think we'll have a healthy market, but I think we're going to see a situation where unless interest rates go high, if interest rates go to 6, above 5, I think we're going to see some effect on the market. So keep an eye on that. Key number 2, low inventory. That will continue, I think, in 2022, a low inventory of houses, meaning a smaller pie that we're dealing with. And, I was an economics major in college. I graduated with honors, and I'm not bragging, but I did teach 2 classes on economics as an undergrad. And in my college, the first undergrad to do that, most of the teachers were grad students. The problem was none of them spoke English, so my class did very well, and that's why they hired me. But nonetheless, economics I have a good grasp of. And if you don't, it's very simple in real estate. It's just supply and demand. So if there's more properties and less buyers, then prices will go down and vice versa. We're in a situation where we've got a low supply of houses. Now, when I say low supply, let me quantify it for you. A normal market would have 6 months of supply, meaning if nothing went for sale, if there were 10 houses, it would take 6 months for those all to sell. And if it's more than 6 months of inventory, then it is a buyer's market. If it's less, then it's a seller's market. Right now, nationwide, we're about somewhere between 0.6 and 1 month of supply. That's really short, and that will continue to get worse in 2022. So that will keep the market stable in terms of supply and demand and prices stabilizing, but interest rates affects demand. And thus, if there are less people in the buying market, that evens the equation a little bit. So less supply brings prices up, higher interest rates can bring prices down because people might want to get in at 3% interest, but if it goes up to 5 or 6, buyers will say, nah, not a good time to buy right now. I can't afford that much house. Does that make sense? I hope it does. Okay, low inventory means less to pick from. If you're working with a real estate agent and you're trying to find houses on the multiple listing, that's not a good way to go. I'm going to be talking about other ways to do that at the Wealth Builders Convention, but if you've already tried that game in the last year or two, you know what it's like. There's just this many sellers and this many buyers, and it's a competitive environment that you probably are not going to win at in most markets. And lower inventory also makes it harder to find deals. Now, that doesn't mean there aren't deals out there. There's always people with particular problems, even in a really strong seller's market. Even in the last year or two, as crazy as it's been in the seller's favor, I found plenty of deals, and so have all of our students. So you have to look a little harder, you have to negotiate a little harder. However, everything you buy goes up in a seller's market. Everything you buy, you can rent, and rents are going up like crazy. If you're a landlord, you know this, but if you're not, it's a landlord market out there, which means that, especially on the cheaper properties we discussed, rents continue to rise and will continue more if the economy softens, because inflation raises the cost of things, which means landlords charge more. And if you have a fixed rate mortgage at today's low interest rates, you're doing really well because the rents keep going up and your payment stays the same, except for maybe taxes and insurance go up a little bit, but your mortgage doesn't go up commensurate to the rents that you're getting. All right. So low inventory is going to be a good thing for sellers. If you buy properties and hold properties, that'll be a good thing for you as well. If you buy and flip properties, you're going to get them sold in a New York minute. But it's going to be a little harder to find them. You just got to get more creative and think outside the proverbial box to find deals. Bottom line, I think we're still going to see a seller's market, but just not to the extent that we've seen it in the last 2 years in 2022. Key number 3, rising foreclosure rates. Now that COVID is, starting to show the end of the light, the light at the end of the tunnel, so to speak, we're going to see more foreclosures. Now, that may, and I put in capitals, may lead to more inventory. If banks foreclose properties, they have to resell them. The question is, what will banks do? Now, in 2008-9, remember when the market crashed and we had all those foreclosures, banks began flooding the market with properties. And what that does is it increases the supply, which brings prices down. Once banks realized that after a year or two, they stopped doing that. Instead of flooding the market, they dribbled them out little by little, keeping inventory limited, keeping prices propped up. And in the end, the banks get more money back for the properties they foreclosed. And I think they've learned that lesson. We'll see it again. Banks don't want to hold the inventory for a long time, but then again, they don't want to lose money either. More defaults equals more opportunities for us to buy as investors. So it's a double-edged sword. If nobody bids at the foreclosure sale, then the bank gets the property and could put it back on the market, causing more supply. But on the other hand, if we can get to people before it goes to sale, we can strike a deal with a homeowner and also help them out as well. And I think short sales will come back again. If you don't know what that is, in short, a short sale is when the bank is owed as much or more than the property's worth. If it goes to foreclosure, nobody's going to bid because it's too much owed. The lender before sale may work with you as an investor to take a discount. So using rough math here, $100,000 house, I know that doesn't exist in most of your markets anymore, but I'm keeping the math simple. If someone owes 150 and it's worth 100 because it either went down in value or because of no payments for a year and a half, the interest just accrued and the payments accrued, then the bank may be willing to take, 75, 80, 85 instead of 150, just take the loss up front and allow you to buy the property, and the seller will sell you the property and the bank will take a short on their payoff. Okay, we'll be talking about that more at the Wealth Builders Conference. And by the way, in the foreclosure scenario or people are in trouble, do not feel guilty. There is nothing wrong with looking for investment opportunities when things are bad. Unless you're in Congress, that's unethical. You've already seen that. You are helping people out of bad situations who are facing possible foreclosure and or even homelessness. So if someone's going to get foreclosed, they're going to ruin their credit. The bank gets the property. Nobody wins there. If you bail someone out of foreclosure, even at a discounted price, and can put some money in a seller's pocket and get them on their way to a new life, you save their credit, you give them some money, and the bank is happy because they didn't want the property in the first place. And finally, you are preventing neighborhoods from becoming blighted. Does anyone remember 2008, 9, 10, when we saw boarded up houses on the block that were foreclosed and banks were sitting on them for years? Nobody wants that ugly thing next to them. It brings down your home value. So what you're doing is a good service for your neighbors in the neighborhood. Real estate investing is about solving people's problems. Find the problem, find a solution, help people out, you make money. The famous Zig Ziglar used to say, if you help enough people get what they want, you'll get everything that you want. So that's what it's about. Number 4, we have an election year in 2022. Now, an incumbent administration, this is not a slight on Joe Biden, but every incumbent administration does this, is going to sugarcoat the economy. So they're going to get out there and tell you how great things are and how wonderful things are. And even though we can see with our own eyes, they are not. And I think they'll get worse before they get better in terms of unemployment, people not working, unemployment numbers, the COVID thing and how it affects businesses and regulations, short supply of materials. We're seeing it in real estate investing. I know I waited 3 to 4 weeks just to get carpet for 2 properties that I'm rehabbing. It's a mess. It's a mess. So also the incumbent is going to rush to get tax increases in. That is a slight on Joe Biden and the Democrats, because they know they're going to lose badly in the fall. And there's most likely going to be a change. And that's not a prediction of economic, political, or anything else. It's just a natural tendency. Whenever there's a voting election of a president, the next midterm always comes out bad for that party. It's just built in. But I think there's going to be an extra rebound, as we've seen in the Virginia election and almost in New Jersey, a Democrat lost, which was almost unheard of, that people, especially independents, are turning away from the Democratic policies of higher taxes, more regulations, and may give the Republicans another chance next fall. So I think likely we're going to see a change in both houses, and that puts pressure on the White House to compromise. And we all know Joe is famous for compromising. He's compromised just about everything in his life. That is a slide on Joe Biden. And then there's the X factor, like, the October surprise. What's going to happen in the economy? Are we going to war with Russia? Are we going to war with China? Or some proxy war in Taiwan or in Ukraine that might affect supply of things, prices, interest rates? That's I should have just a big question mark there. I don't know. We all don't know. The rule book is sort of gone out the window. If you told me that 5 years ago that the stock market is going to be at 35,000 while at the same time there's a worldwide pandemic, interest rates at 2%, at the same time people not wanting to work for even $18 an hour at McDonald's, I would have said you're crazy. But I don't know what's coming. I don't know what that X factor is, and neither do you. And then number 5, of course, could be a COVID surprise. Nobody saw this terrible fiasco coming. Nobody can be really sure what's next. We're only up to O for variants, right? Omicron, we could be up to Zeta by the end of the year. Who knows? And your local government, I don't think the feds will as much, but the local governments where you are in investing in real estate could do something really stupid. put a regulation in place, put economic things in place, put movement restrictions, building restrictions, closing building departments, not allowing showings of real estate houses. You just don't know what that X factor is when it comes to COVID surprises. So just, keep those variables in mind. The three things we kind of really don't know is how far interest rates are going to climb. Number two, what's going to happen in terms of the COVID regulations and the COVID problem itself, the disease and how it affects people, and the supply factor. Are we going to continue to have shortage of supply of materials that may make, for example, fixing and flipping houses impractical? Just impractical. I was just, as a lawyer, I'm negotiating some commercial leases for landlords, and I'm usually putting in there that if a landlord is notified of a problem, they'll fix it within 2 weeks, but I can't guarantee that anymore for a client. So I'm telling you, just take that out and say, 60 days or more, because if you can't get a supply for a part for an air conditioner or a roof or something like that, that could really put a monkey wrench in your operation. So just be prepared for the unexpected. And no matter how bad you think it is initially, ask yourself that question. How can I make this work for me? All right. Just remember Sun Tzu, The Art of War. In the midst of chaos, there is also opportunity. So if you ask the question, how can I make this work for me? You'll always do well in your real estate business. Thank you. All right. Let's take some questions.
Awesome, Bill. That was great.
Thank you.
Okay, so when we look at what's happening, one question has come in from Nancy Rodriguez, and she's on Facebook. Thanks for the question, Nancy. And she says, do you think we're going to see the downturn of 2008?
No. 2008 was different factors in the economy. 2008 was caused by three things. It was caused by overbuilding, oversupply. So, for example, I'll give you numbers in my market so you understand. Normal supply in Denver Metro is 25,000 homes, or give or take. By 2008, we were up to 32. And we're down to about 4,000 homes. So we're at like a 1/6 of inventory. So there is no inventory problem here or anywhere else in the United States for that matter. Now, a lot of builders have made commitments and they're going to continue those commitments. They may continue to build houses even though there's not a lot of demand because they just, they have the permits and they can suck it up and build homes and sit on them for a couple of years before it turns around. So that may tick up inventory, but just not enough. There's not enough building. There's not enough homes to really affect that supply-demand equation. Also, of course, 2008, everyone knows, was the lending fiasco where people were putting no money down and getting 1% interest to start with, and then it adjusted in a year up to 6 or 7. We just don't have that. Lenders are still requiring, for the most part, 20% down on conventional loans, and they are putting people through the ringer to make sure that they qualify. There are some stated income loans, meaning you basically fudge your income, like people do, but it's only for owner occupants, it's not for investors. And those people have very strong FICO scores and reserves.
Wow, that's really interesting. We've got a couple more questions, but I want to press in just a little bit. So I was in banking during 2008 and sat across from federal regulators. It was not a fun time.
Yeah.
And I've often thought, like, what is the difference? But did I hear you correctly that inventory is kind of the main reason that we're not going to revisit a 2008 issue?
Well, it's supply and demand. Supply is short, demand is high. Now, supply is not going to come up significantly in 2022. That I can say with confidence. What I don't know is what's going to affect demand. And interest rates spiking will affect demand. Regulations excessively that prevent people from getting loans through or qualifying for loans. Let's say the government, because of the economy and COVID and all these other factors, decides to say, well, banks, you have to have more money in reserve to handle all these potential defaults we see coming, and banks just get tighter with regulations that only fewer amount of people can qualify. That shrinks demand.
All right,
and that
that's
affects
awesome.
price.
Yeah, thank you. Okay, this question is from Bree Baker. Bree, thank you for your question. And she says, how do you know if a seller's going the foreclosure route and then that we can step in? In other words, how do we find foreclosures to know to step in maybe before that goes on MLS or goes out into the public?
Well, if you go house to house and put your ear to the door, you can hear the crying. I'm just kidding. I'm just kidding. No, that's me. In reality, in all seriousness, foreclosures are public record in every state. So there's a document that gets filed publicly in mortgage states, that states that use mortgage documents. It's called Liz Pedants. And in non-mortgage states that use trust deeds or deeds of trust, like California, Colorado, Texas, it's called a notice of default, and that's filed, publicly. So anything that's filed publicly can be bought as a list, and there are millions of companies nationally and locally. You can buy that list.
Wow, great. And this is a question. Albert Sue is on, and I know Albert is so good to have you on, Albert. And he was just asking if he can ask some questions about maybe share market or crypto. And I'm going to tell him yes, Bill, I think you can handle that. So, Albert, yeah, go ahead and submit that. All right, this is from Eric Reamer, and he says prices are starting to come down in his area. Is that seasonal or starting a new trend? He's not sure if other areas of the country are seeing this.
Mhm. Well, there are seasonal fluctuations. That is natural. It is natural. We're in December now. We're not in August. So people tend to buy in most markets between the spring and the fall when the school is out. It's easier to move with the kids, and you want to get them back in school, back in the new house before school starts. So it's natural between Thanksgiving and New Year's that things do slow down, prices slow down, houses sit a little longer. Now, it may be the opposite in some markets, like some seasonal markets that are vacation areas are seasonally different. So the winter might be the strong season, the summer might be the weak season. There's an exception to the rule, but generally speaking, the summer is when things get better, and in the winter, things get a little worse. It depends on really where you are. You have to look at not just season over season, but year over year. What was it like last December?
Yeah, that's what I'm wondering too. And so, Eric, if you can, I'm just watching the chat section. If you can tell us the area you're in, that would really help to answer this question.
Yeah.
So I'll be watching for that. But in the meantime, we'll go on to this next one. This is from Celeste Goff. Hello, Celeste. Thanks for joining us. She says the current administration is looking to eliminate fossil fuels and have more electric, with some landlords and homeowners' residences, since they're powered by natural gas. Could this be squashed with a new administration?
I don't think natural gas is an issue. We have a pretty good supply of that. Home heating oil is a problem. Home heating, in the Northeast, where older houses use home heating oil and they have tanks underground, it's really spiked in price. I mean, just like gas has gone up, home heating oil has gone through the roof, and this winter is going to be real tough on those people who own those homes. I would watch out for that.
Okay, great. Thank you for that. And Eric did respond, Bill, and he is in Milwaukee, Wisconsin.
Yeah, that's a seasonal market, and right now it's pretty darn cold there, I'm sure. So I'd imagine, if there's not snow on the ground already, there will be soon, and the market's going to drop naturally in the winter. Now, last year was a little different. Last year was a rebound effect because in 2021, the first, not the first quarter, but the second and third quarters, we were at a halt in this country. For everything. So nothing was getting sold, nothing was getting closed. So I think the latter part of 2020, we saw a rebound effect. And now year over year, people are saying, well, wait a minute, prices are not moving as fast as they were last December and November. Yeah, that's true, but it wasn't a natural market last December and November. So I don't know if you can really go by those numbers, or you should go by 2019's numbers. For not the price, because the prices will be up, but the number of houses sold, the days on market, things like that. I think that's more accurate.
Wow, what a time we live in.
Mm-hmm.
Okay, Daryl has a question here. Daryl, thanks for chiming in with your question. I appreciate it. He says, you mentioned building our own inventory of starter entry-level houses.
Mm-hmm.
Do you see this as a rental strategy to buy and hold, or like how could you
Oh,
actually go
yes.
forth with this?
I would buy and hold starter homes because they will rent well. Remember, when the market softens in the real estate market, the top starts first, not the $5 billion house that Jeff Bezos or Elon Musk owns, because usually that home, is a seventh home. I'm talking about if you're like, let's look at Denver. Denver, the median is right around 500,000 right now. So once you get up to about a 800 to 1,500,000, that's going to soften first. But anything 500 and under is going to stay fine because that's the low end. So if people get foreclosed on an $800,000 home, where do you think they're going to rent? They're going to rent a $600,000 or $500,000 home. So you're actually increasing demand for those lower end homes. And rents probably won't go down. More people getting foreclosed means more tenants.
Yeah, they have to move somewhere.
Move somewhere, and those houses, they're just not building them anymore. If you're a developer, think about the logistics. You got to buy a piece of land. You have to get the sewers in and the roads and the power, and then when it comes down to building homes on little tiny lots now, it's just 2x4s and drywall. That's cheap. So why would you build a 1,500 square foot home when it's just as efficient with all those fixed costs to build a 4 or 5, 6,000 square foot home?
Wow, that's so true. Wow, that's so good. Thank
Mhm.
you. This is coming in from David Armstrong, and he says speaking with bankers about policy changes regarding foreclosure sales is really interesting. He says, I've received several different scenarios. Any suggestions on how to guide the bank people to an appropriate policy? By that, I mean one that favors investors.
No, they won't. Banks do what makes them money and what makes bank regulators happy and makes their shareholders happy, which is making money. So if we're up to banks, they would just, do all kinds of crazy lending like they did in 2008 and, to heck with the consequences. But the regulators won't allow it. They won't allow that kind of activity anymore. They want banks to sit on more cash. Because remember, when you deposit $100 in a bank, they don't have $100 sitting there. They have, $10 sitting there, and they're investing 90 of your 100 somewhere else to make them the money. So if the regulators tell them what level of reserve they're required to have, and the worse things are in the economy, the worse things are in their default rate, the more they're going to require to hold in reserve. That means they make less money if they're not investing.
Yeah, I remember those days well. Thank you so much. This is coming in from John Griffey. He says, what are your thoughts on buying underdeveloped land for trailer or prefab homes?
I think that's an excellent opportunity, depending on where it is. Low-income housing generally in this country is in really short supply. And what I described as a starter home, I used to buy those homes in Denver for 60 grand. Now they're $500,000. And that's true everywhere. Even in the cheapest markets in the South, you used to be able to buy those homes for 40 grand, 30 grand, and now they're going for 150, which in that market's an expensive home. So if you can create more affordable housing, RV parks, mobile homes, prefabs, and things like that, there's definitely opportunities for those.
Wow.
And the local governments will work with you with tax breaks and financing and funding for those types of things. So look into that.
Is there anything with that they need, like we need to be aware of that's a risk, an underlying risk that may not be obvious?
Tornadoes. For some reason, mobile homes always attract tornadoes. Now that's an old joke in the mobile home business. The reality is a lot of the tornado belt has a lot of mobile homes. Florida too, where you have a lot of windstorm. That's where they tend to be, those parks. So there's a lot of risk of windstorms, tornadoes, things like that. There's a lot of senior mobile home parks, upscale, really upscale 55 and over is a hot commodity.
It is. I mean, some of the financing is something you have to kind of watch out for. Depending on your area, like prefab homes, and even mobile homes are really okay in some areas, and you can even get conventional loans if it's got a foundation or maybe it's on footings, but not in every area. So that's something to check out too, like what's acceptable in your area, because you might be surprised the type of financing that you can come up with.
Yeah, and it's especially older homes. Older mobile homes are almost unfinanceable. Anything older than like 1990, 1995, very few banks want to touch a loan on that.
Yeah. Okay, that sounds good. This is coming in from Sean Agnew, and he says this is using equity in my condo, which I'll switch to a rental property as a down payment for my next home, wise in this uncertain time, or will that backfire down the road? And he's actually located in the Denver metro market.
Okay. The only danger in refinancing, I mean, there's two different, did he say put an equity line of credit or refinance?
Yeah, well, he just basically said using equity in his home.
Okay.
So it could be a cash out refi or home equity
Right.
loan.
Okay, so if you get an equity line of credit against your equity in your house or your condo and use that as a down payment on another house, those home equity lines of credit tend to be floating rates. They're not fixed rates. So if interest rates go up, that 20% you put down on the second property, that payment is going to go up accordingly. So you have to look at like, what's the worst case scenario there? If you just simply refinance your condo and pull out equity with a fixed rate loan at these rates today, I don't see how you can go wrong.
I agree, Bill. And actually, we've been talking to coaching clients about that. And people want to tend to go right to the home equity loan, but that's right. It might
Yeah.
start out with like the
Right.
interest only payments. It's a variable
Right.
rate. And when we're in
Right.
this low of interest rate environment, why
Mhm.
not go conventional? The other thing is sometimes to avoid some of the closing costs, your lender, if you pay your loan, they don't want to lose you. They don't want to have to go out and get a new customer to replace you. So one thing you can do is call your current lender and let them know that you're thinking about doing a cash out refinance and see if they can give you a deal to stay with them. Many of them will do that.
Sure. That's great advice. And in terms of, home equity lines of credit, those are good for buying homes that you could fix up and resell or refinance and pay off that line of credit within a year. Or if you're going to do the home equity line of credit as a down payment on another house, as long as you take the extra rent from that second house and rush to pay off that home equity line of credit before it pops, I think it'll be okay.
All right, that's great. All right, Albert did submit his questions now that we gave him permission. Albert, thank you. He says, regarding share market, the share market in general is still going up. What are the driving forces? He goes on to say, and in 2022, will yield continue to lower? Would it be an idea just to pull all the money out and put it in property or real estate related ETFs because of the demand and supply reasons of real estate?
Right. ETFs are a little tricky. I'm not a big fan of those in real estate. There are a lot of advertising on TV, a lot of private funds that are paying higher yields, and then you have your REITs. It really, I'll give you the lawyer answer. It really depends. It depends on what their game plan is. I see these guys advertising on TV. I don't remember the name of it, but they keep saying, don't fight the Fed, flow with the Fed, meaning as interest rates fall, property values will go up. That's our game plan. Well, what's their game plan now? Now that interest rates are going up, it's got to be something better than that. I mean, if you're investing in a fund or a REIT that says we're going to buy multifamily apartments over the next 10 years, I think that's a good play. Or we're going to buy up farmland and convert it into houses in suburban areas or semi-urban areas, that might be a good play. But just saying, real estate generally in a broad ETF, I don't know if that's enough.
Okay, that's great. And then can you just comment briefly on cryptocurrency?
That's another X factor. Good question. From day one, I looked at that as a stupid scam. It's becoming more mainstream. And the reason it's becoming more mainstream is that, government policies like we want to watch the transfers in your bank account that exceed $600 or $1,000 a year. People go, I don't want those eyeballs on me. I'm going to go to crypto. Terrorists are using crypto. So, there's a motive there that people have, sometimes bad, sometimes good. But there's a lot of young people who are investing in crypto. That's the very young person's game. Because they're looking at it as I don't trust the stock market. I can't afford real estate. So I'm going to put my money in crypto in little pieces because I think that's the future dollar is crypto. Now, whether that turns out to be right or not, time will tell. But will that affect the real estate market in 2022? No. Maybe someday you can borrow against your crypto account to buy a house. I'd like to see that.
Yeah, it may get there.
Yeah.
All right. This question is from Valerie Cooley, and I don't know anything about what she's saying, so I'm really curious if you're aware of it. She says, do you know anything about mortgages being securitized during the housing crisis of 2008? And if so, can you speak to this? Is this a bad thing? Is a homeowner ever really able to pay down their mortgage that was securitized? And are you familiar with a case that was won against a bank in Texas for $45 million?
I don't know which case they're referring to. There's a lot of cases on this stuff, but I'm just a little in the dark what she really means by securitizing. All mortgages are securitized with collateral, a mortgage against a property. Is she talking about taking the pool of funds and collateralizing them with money in the stock market, like a lot of banks did these mortgage-backed securities in the 2008s? I'm not sure what she's referring to.
I'm not sure either. I read that and I wasn't familiar. So Valerie, if you can just post some clarification on that, we'll revisit that and see if we can clear that up. This is from Ed and Chai Long. Hello, Ed and Chai. I hope I'm saying that right, or Che. Lot to talk of single family homes, no multifamily. Do you guys work with multifamily at all?
I just mentioned multifamily. Multifamily, yeah, multifamily is a good play too. Especially the same market, that middle, not low income, but low income places. In the commercial business, they call that C plus, B minus. So A is where we live, B is where our kids generally live, and C is where we want to invest. So C could get bad. So like C plus, B minus, right on the cusp there of not too nice, but kind of old and a little raggedy, but not crime ridden and dangerous.
Mm-hmm. And do you think, can we talk a moment about financing multifamilies? Because there's some really pretty strict rules, or you might say clear rules, as far as when it becomes a commercial loan and when you can still finance it on the conventional market.
Right. So conventional loans for residential go 1 to 4 family. Once you hit 5 units, there's nothing in residential financing for that. Commercial financing for multi-units usually starts at about $1 million, sometimes $2 million and up of a loan. Now, how can I make this work for me? The question, I'll answer it. It's very simple. If you find a seller who's got 5 to 10 units, and it's not a big enough loan, and it's not like LA or San Francisco or even Denver for that matter, where 5 units could be $2 million. Maybe in Huntsville, Alabama, 10 units might be an $800,000 apartment on the lower end. So a lot of banks don't want to touch that for a loan, and that means the seller has to work with you either on giving you an unbelievable price, or maybe carrying some of the financing, being a little flexible on the financing, maybe carrying back all or part of the purchase price and payments. That's how you make it work for you. So it's a challenge for you to get financing, but sellers know this, and they're willing to be flexible in that market.
That's really good. We're looking at this 8-plex down in Florida that's next to a property we just purchased. And it's got a triplex, and a duplex on it.
Right. Good luck getting a loan for that.
Exactly. And so we've been talking to a lender, and the closing costs are outrageous. But you know what, Bill? You just sparked an idea. Just like in single family homes, you can ask the seller to cover a portion of your closing costs and build it into the actual purchase price. So that would be a possibility. But Billy was helping us with it and looking at it, and he said, hey, I'm going to give you a tip here. And now I'm passing it on to you guys, so you can thank Billy for this. Because they're separate buildings, he said you can actually replot those buildings.
I was just going to say that. I was going to say, if there's room, if the property is such that it could be subdivided into 3 lots, what you have is a 3-unit, a 3-unit, and a 2-unit, 3 separate loans in the residential market.
Yeah, then they're all able to be financed through Fannie Mae, Freddie Mac. So that would be
Yep.
amazing.
Yep.
But multifamilies, there's a lot of people that are interested in that, and they start out with single family. How much of a risk, additional risk, is multifamily? And Bill, can you just describe to us, like, what do we look for just in a 30,000 foot view for a solid multifamily property?
Mhm. Well, multifamily is all about the math. When you buy a single family house, you're looking at value, comparable sales, what you buy it for, what you can fix it for, what you could sell it for, what you could rent it for. When you look at multifamily, and for that matter, most commercial, it's all math. What does it bring in? What are the expenses? What are the cap rates? What are the operating costs? What's the net operating income and so forth? Those are terms of art of the industry that you could definitely learn. And I still think we have at WealthBuilders this year. We have someone talking about commercial, don't we have a commercial real
Yeah,
estate?
we do.
Here we do.
Absolutely do.
We do. So you'll be learning about that. But in a nutshell, with multifamily, what you're looking at is the same market I talked about, that B to C type property, because A is gonna get hit hard. I think if the economy softens, we've seen a lot of building of high-end apartment buildings, and they're going to get hit hard. There's a lot of supply of those. They're doing very well now, but if the economy turns just a little bit, those are going to get hit hard. So don't be investing in that stuff. Be investing on the older, not too old, not too hard, not too bad of a neighborhood, but just on the border that you can maybe put a little work into it and then increase the rents a little bit or manage it better than the seller's been managing. A lot of sellers are, especially the ones you described, that 8-unit, probably an old timer and his wife renting it out, and they haven't raised rents in 4 years because, well, we have it completely full and we don't want any problems. That's just silliness. You have to raise rents. It's just a question of what you can get away with before people start balking and leaving. And sometimes that's a good thing, depending on who the tenant is.
Yeah. Or you have to put updates in and you
Right.
don't want to,
Right.
so
Right. They figure, well, we'll run it like a kind of a semi-slumlord, and the tenants won't complain because they know we'll raise their rents if we have to do that. And I don't think that's a good formula for anybody. You're better off keeping it running a little better, a little cleaner, a little safer, and just raise your rents, reasonably.
Awesome. Okay, this is coming in on Facebook, and this is Tanya Elizabeth Rodriguez. Hello, Tanya. Thanks for joining us. She says, what is the best marketing strategy to find off-market deals? Is SEO marketing at the top of the list?
No, that's at the bottom of the list. People are relying too much on technology to find and negotiate deals. You can use technology to, widen your net a little bit, but in the end, you got to get on the phone and then meet someone in person, belly to belly, and negotiate a deal. People are negotiating over text, Instagram, Facebook, email. That's just terrible. That's the one reason why real estate agents will always have a job, because people are afraid to go face-to-face negotiating. And that's why you need to have those skills and use the technology to get in front of someone. Don't use the technology to negotiate.
Wow, that's awesome. All right, Valerie got back to us to give us a little bit more information on what she was talking about securitization. She says she's referring to pooling on the market, commingling many mortgages into a pool, which returns are paid to secondary market investors who purchase mortgage-backed securities. Is this illegal?
No, it's been done for 20 years. There's some people out there saying you could file a lawsuit to say that practice is illegal, and they cite a bunch of old Supreme Court cases. It's a scam. It's a scam. There's been a couple of judges here and there who have had semi-favorable rulings to borrowers in that regard, but you seriously think that you're going to go in front of a judge and say, because of this technical thing, I don't know the bank $500,000 on a routine, cookie cutter basis? It's just not going to work. It's like, it reminds me of those people who used to, advertise this system where you don't have to pay taxes because you're technically not a citizen of the country. You're a citizen of the county, or some kind of, fakakta argument like that. And all these people went to jail and the IRS arrested them all. But people who did it and bought into it ended up getting penalized and paying taxes and back penalties and fees and attorney's fees.
And that would be a very similar situation to this.
It's not a viable strategy. I mean, there have been rulings here and there where people have won here and there, but you want to get something that's repeatable.
Yeah. Okay, that's really good. All right, this is coming in from Chamati, and Chamati says, "What impact do you think tokenization and NFTs have in traditional investing, particularly in real estate?" And if you can, I don't know what she's referring to as an NFT, so if you can explain that, I don't think I'm the only one wondering that.
That's a crypto thing. It's what's called a non-fungible token. And I don't really understand it that well in that market because I'm not really much of a crypto person. Maybe someone else is there. I saw someone posted that they're an old person investing in crypto. Good for you. Because I said it's a young person's game mostly. It is, with exceptions. But again, my general feeling is crypto in the short term is not going to really affect the real estate market one way or the other. If it becomes the standard currency instead of the dollar, yeah. If they allow you to borrow against it, yeah, that's a good thing. If crypto really becomes a more standard thing, if some countries start accepting that instead of a dollar or a euro as their standard, if China says, forget you, United States, we're going to invest in crypto, we're in big trouble.
Wow, there's a lot happening there that we don't have time to talk
Yeah.
about tonight, but we
There's a
might be
lot to
able to
unpack
talk
there.
more about that at Wealth Builders. That's really good. Okay, very, very helpful. Here's another question that's coming in. This is from Nancy, and just wondering about the market of California. And I just remember in banking, we went through a time, matter of fact, I was just sharing this with my son, that there was a period of time that when I was a mortgage lender, we could not do loans in California. We couldn't do loans in Las Vegas. And at that time, there were pockets of Florida. So, do you think that the 2008 type scenario is going to be possible in a place like California?
I don't think so. I don't think so. Those were areas that were overbuilding, so inventory was too high and the lenders saw the writing on the wall. I think, what we're seeing now is not regional, it's nationwide. And there's some pockets here and there that are better or worse, but nationwide we're seeing low inventory. Interest rates are national, supply and demand is local, but we see low inventory everywhere. What happens in California is not necessarily, if it's a micro thing affecting the whole country, because their economy may have different factors, such as immigration and so forth. Real estate, when it gets down to it, is all local, but the trends that we're seeing everywhere.
Wow, that's great. All right, and David Armstrong just asked this, and it's a question that I'll try to answer here. He's asking if Wealth Builders considered an IRO for members to invest in. And David, thanks for the question. David is part of our coaching program. With Wealth Builders investments, I think we're going to see quite a bit coming on board in 2022. I know we'll learn a lot more about that at the Wealth Builders Conference, but I do know that something like what you're describing is definitely on the table, or at least looking at it for consideration. So that's really good news. All right, I am going to take a moment here. Oh, one more question, and then Frank and Mike, I just want to kind of make you aware I'm going to be calling on you for something. But Celeste is wondering, Bill, can you practice law in Florida?
To some extent. Interstate practice of law is highly regulated because licensing is by state. However, I happen to have the advantage of a brother who's admitted to practice in Florida. I can work through to some extent, depending on what's involved. I mean, I can't litigate in those courts, obviously, because I'm not admitted to practice there, but I can hand it off to my brother. However, if it's a matter that involves some Florida, some generic things, yeah, I can work with my brother there, and he can do some or supervise some, or so forth. Certain things don't need, that are national. Like, for example, people ask me all the time, "Can you form an LLC in North Dakota?" Yeah, that's no different than what LegalZoom does, right? I mean, LegalZoom is not really practicing law, at least I don't think they are. But the general, the rules are starting to, get a little fuzzy with interstate practice of law, especially in the last couple of years because of Zooming. The technology has changed where people are actually practicing from and practicing to. So the state bars are, starting to tweak and adjust their opinions on these things. So it really depends on what it involves. You know, I can consult obviously anywhere. If someone calls me up and says, "Can you help me figure this challenge out?" Yes, I can, or organize, or this transaction. Can I evict someone in a court in your state that I'm not admitted to practice? No, I can't. I wouldn't do it anyway. I don't do those things.
Yeah,
But
I can just tell
yeah.
everybody that, if you talk to Bill, Bill is absolutely amazing. He is so full of knowledge, and you're just getting such a teeny part of what Bill knows. And so I would encourage any of you, if you've got a legal need or a question, reach out to Bill, and we'll put his contact information here with the Wealth Builders team if you wouldn't mind posting it. But basically, they can contact you
They can
at.
contact me. I can tell them, the extent of what I could do, or refer them to someone else.
Oh, that's awesome. Very, very good. All right, Frank, I gave you a little heads up here. I'm going to throw a question your way. And this is coming in from Stephen Baca. And Stephen asks, is using a property management company worth the cost?
Well, I'll quote Bill, the lawyer's answer, it depends. I mean, I'm a big advocate of maybe self-managing your first 2, 3, 4 properties, because as Bill has taught me, what you don't know about, tenants, they're going to teach you. But I think you learn a lot and get some good, solid information and education when you are working with a property manager. You know the right questions to ask, what should be done. I mean, if you've got a property that is away, a long distance away, I think property managers are great. And as you accumulate more properties, it's going to take your time away from building your portfolio and the other things needed. So I'm a big advocate of property managers.
Awesome. I agree with that. Especially if you're not right there in the area to be able to check on your property. All right, so Bill, I've got one question for you, and then Mike, I'm coming back to you with a question. This is coming in from Jeff Summers. Hey, Jeff, he's right here where I am in the Dallas-Fort Worth area. And he says he's running into a major influx of overpriced properties that Zillow and OfferUp and other companies have purchased and paid over asking, which has driven up the cost of comps. Add to that the influx of people from the West Coast and East Coast bringing tons of cash into the market. It has been driving up property values and running a lot of people out of their homes. Do you see any relief coming in the next year or two, which will soften the market in our area? And he just notes the inflation rate is climbing, adding to the mix of the mess. He just noted I have to pay $25,000 in January for increased values on 8 properties due to this scenario. And he said it's getting stupid. Rents have gone up, but almost at a break-even rate. He was tempted to sell out, but nowhere to put all the profit. He says he's frustrated in Fort Worth, and thank you for helping.
Yeah, Fort Worth is a growing area, and I would stay. I would hold. Between Fort Worth, to Dallas used to be 2 cities. Now it's becoming a blur. So anything along, it's Dallas Fort Worth Airport, not Dallas Airport. Remember? So I would hold. The Zillow thing is over. Zillow took their lumps, and now they're dumping what they have. They went in and bought properties at way overpriced. I don't really understand their model. Maybe they just overpaid for the properties and made funny money on brokerage fees, lending fees, and other types of things, just to pump up their stock value or whatever they're trying to do. I don't know. But whatever it is, their experiment failed miserably. So we're going to see a lot less of those big institutional buyers in 2022. Well, and in some sense, it's a good thing. It drives up your values, means you can get a bigger loan, which means you could sell it for more. But again, the same challenge is, what do you do when you sell it? Where do you put it? And we'll talk about that at WealthBuilders, by the way. But I think that phenomenon is going to soften quite a bit. But I would buy and hold in an area like that.
Okay, that's awesome. And Mike, just to finish up tonight, a lot of people are looking for where to purchase in this market. We know that the market is really hot, and you had a pretty darn good strategy that's worked well for you. So what would you suggest for people that are looking at purchasing investment real estate? How should they go about finding a place?
I would first look at smaller towns, under 200,000 people. If you go to Denver, even Colorado Springs, those prices are so escalated, and if you're getting started, you know, you don't want to spend $500,000 on a property, especially if the numbers, it's not going to cash flow for you. So I would look on the fringe of those bigger towns, and you can Google the size, the populations of towns. You know, I would look on less than 200,000 and even go to the bigger cities. We always tell people, our coaching clients, if you got relatives that live in smaller towns, talk to them and visit them. That would be the great advice that we could give somebody like that.
Oh, that's awesome. All right, Bill, any closing thoughts? And please tell people how they can get a hold of you.
Okay, we'll type it in there. It's bill@bronchick.com, my last name, just like you see it right there, bill@bronchick.com. My law firm website is bronchicklaw.com. Those are the two best ways to reach me. My cell phone number, if you have any questions for free, I'll be happy to answer them. No, not really.
I was like, whoa, what's this?
Not really. Best way to get me is email or through the website, through the questionnaire form there. See a list of services that I do perform and drop me an email. And I look forward to meeting a lot of these people and seeing, you know, people who I've met before at the Wealth Builders Conference.
That's awesome, Bill. Thank you so much. And again, this is just a small taste of what Bill knows, but also what you're going to experience at Wealth Builders 2022, where Billy and Becky are committed to making sense of making money from making a difference. And they bring the wisdom of the kingdom of God in with the practical. And it's those two together that we're really seeing a lot of success. And you know what? We are called to have generational wealth and leave a legacy. So Bill, thank you so much. And just to
I have one more thing to share. One more thing to share.
Yes.
Merry Christmas, everybody.
That's so awesome, Bill. And again, if you haven't registered for the Wealth Builders Conference, take advantage of, we have 20% off right now. So use the code WBSALE and you can register at wealthbuilders.org. Go to events and you'll find the link for this. And that actually gives you $60 off your Wealth Builders ticket. So just like Bill said, we just want to wish you a very Merry Christmas from Wealth Builders. Billy and Becky send their love to you. And we look forward to seeing you in the next series here where we're continuing these webinars up to the Wealth Builders Conference. Thank you, everyone. Thank you, panelists. God bless you.
Pleasure.
All right. Have a
Take
great
care.
day.
Merry Christmas.